Good day, Red Hot Storm Trader, and welcome to the first webinar of April. So today's webinar, I'm going to go through our watch list, and it's basically going to show you the world of fake outs. Now, a fake out is when the market moves in a certain direction, breaks above or below that direction, and then goes the complete opposite. So this is a trader's nightmare, especially for breakout traders. But I mean, I'm not surprised. It's April. They are full of public holidays. People are tired. They're coming back from holidays, so they don't know which way the market's going to go. And also with the nepotism with politics at the moment, with the petitions that are going around with the anti-Zuma movement, and also with the newly appointed finance minister not knowing what's going to happen, who can blame them? So, you know, the best is to sometimes being neutral is the best position in the market, purely because if the market doesn't know which direction it's going to go, how can we? So the first thing we can look at is the ALMI, the All Share Mini Index, which is what we would trade. Okay, and what I want to show you is that there was a beautiful W formation forming from the 1st of September 2016 all the way through till March, and it formed this W formation and it broke out, which showed some upside to come, but then it had this very downside candle or negative candle where the open, then the market tested at the 47,800 mark, and then it came back down to 47,200. And what this means is that there was not much demand as the candle started at, which means that there was a chance of a fake out, which there was. So there was a breakout, and then there was a fake out, which brings us into a new market environment called the sideways market. Okay, so you get the bull trend, which is above the previous highs, and then you get the bear trend where it's established that there is downside in the market, and then you get the sideways trend, which is between where the bull and the bears are, and that is where we are. So when you see this, basically you can expect a lot of fake outs in the market and not a lot of movement, you know, in terms of opportunities for upside or downside, and no matter which way you take the market, it can be disastrous. Okay, and another thing that confirms this is I've placed a 200-day moving average, which is probably the most popular moving average worldwide. Even Bloomberg uses it, and basically when price is above, there is a bullish tendency, and when price is below, is a bearish tendency. But for the entire year, last year and this year, you can see it's been acting more like a rubber band. So price goes up and then above the standard deviations above, and then it goes back down to tests it. Up, down, and you can see it's just been oscillating around this movement, and now it looks like it's going back to that level. So we have not established a strong directional trend. And if we go through some of the stocks, we'll be able to see Anglo sideways movement, even though it's trying to get some traction to the upside. And that's Anglo Gold, not Anglo Resources. Aspen, same thing. Even there's gaps, and when there's gaps in the market, you don't want to trade it because there's a lot of volatility and it can jump your stop loss. So I'm avoiding that by all means. African Rainbow, you can see it broke above the 200-day moving average. It stayed above, and now it's been breaking below and above, which shows this sideways trend. However, it has established more of a downtrend, but we do not see a trade lining up. Barloworld, since it's broken the 200-day moving average, has been moving up on a beautiful trajectory up. Currently it's 116.52 cents, and it's forming this little, let's say, a pennant formation. So here's your pennant. Okay. And if it's more than 3 months, then it's a wedge formation, which is bigger than a pennant. And if it breaks above, that is a potential area that we can get in. So I'm going to write this down for Barlow. which could be a potential trade going forward, but not just yet. It could take a week or two to line up. Okay, so I'm writing a pennant formation. You may also write it down, so just in case you get an SMS for a trade, you know potentially of what the trade could be before you even read your message. Okay, Barclays, nothing going on there. Billiton, sideways movement, tons of these gaps, which is something I try and avoid by all means. Very dangerous to trade with. Richemont, also gaps in the market, and normally when there's gaps there is a 70% chance of the market going back down and filling the gap before it goes in a certain direction. Clicks, nothing. Discovery, it's made a very strong uptrend and then it broke below, purely because this is an unsustainable trend. Okay, so the angle is more than 45 degrees, which signals instability and possibility that the market will break down, which it has done so. Okay, famous brands, nothing. Sideways movement, as you can see, since November 2016 the market's gone absolutely nowhere. Kumba, we took our stop loss, but we saved a very big potential big loss over here. You can see it's currently at 177.92, testing the previous support level, as you can see. And if it breaks above, only once it breaks above, say 230 Rand, that's when we could go long again. That's when the system will say it's time to go long. But until then, we saved ourselves. Mondi, nothing. Mr. Price, sideways and in the downtrend since it's broken below the 200-day moving average. Massmart, nothing. So if there's one thing you can pick up from this webinar for the month, is this 200-day moving average. Throw it on your chart. You've got nothing to lose, and you'll get an idea on which direction the market is going. And if it does oscillate above and below the 200-day moving average, it is not established a strong trend. It is in a sideways trend. So for example, here's Nedbank. It broke above, and since July 2016 all the way through till April, only then it's broken below and it's entered into the sideways trend, which is confirming the analysis of the Aussie. Netcare has not had a good run. Okay, it looks like it has just been on a one trajectory direction down, all the way from over 43 Rand. Okay, let's see, Pick n Pay. Pick n Pay, there was a very big fake out where it formed this cup and handle formation. It broke above. I was not convinced to send you a trade purely because the next couple of days it just did not show that traction that I wanted to go up. Over here I was I had a little bit of regret. Okay, that's what you do go when you trade, but you can't win all of them. But then over the next couple of days we were lucky that we didn't take that trade, because we wouldn't have hit our take profit level, which would have been around 78 Rand or so, and today it's at 63. So it is also in the sideways trend. Raynet got away from me, I got to admit. It did form this W formation, it broke above, and it went above the 200-day moving average, and it went up. But you know, I can't, sometimes you don't know which ones are going to do well and which ones aren't, and this one just got away from us. Also from the excellent quarter that we had last quarter, I didn't want to break that reputation just yet, but I do understand that it's April now, and May is also very similar, where it goes into a sideways trend, and it could be the quarter that we have not better than last quarter, but it could be a quarter where we either break even or we make a small profit, but I'm not sure. It all depends on the market. And as I say, this is the realities of trading. This is a forever income, which means that you know, a quarter according to 5 or 10 years down the line is nothing. And that's how we have to see it. ShopRite, also nothing going on. Sanlam, sideways. Spar, nothing. Tiger Brands, Tiger Brands is interesting because since it broke above the 200-day moving average, it has just been going up from 306 Rand all the way through to over 431 Rand. It's been beautiful. But the thing is, I'm a breakout trader and I prefer getting into breakouts rather than trend trading. So if you want to use the 200-day moving average as a trend indicator for entry and stop loss, by all means you may do that. Just test a couple of trades, maybe 20 trades in the past, 20 trades going forward, and then you've got a solid system, and also know where you're going to be putting your stop loss. Okay, the Foschini Group sideways. Telkom not established any trends yet. Truworths, another fake out, formed this cup and handle, broke above. It did not look convincing, and it broke below where it would be at your entry level actually. So again, these trades did line up, but I was not happy with the Aussie in general. These are things that I cannot really teach you. This is probably experience that's the reason why I have the Red Hot Storm Trader, because I recognize these patterns and how these markets move over the last couple of years that I've been seeing them. But if you do see it, then fantastic. Same here with Vodacom. We could have taken all of these trades and it would have been loss after loss after loss, and fortunately we didn't. We have saved ourselves from taking those losses because it broke above and then went right down where we would have had our stop loss. Okay, and Woolworths has been on this long trajectory and trend downside and is not showing anything for upside. So the only potential trade really is Barloworld, which I'm also not 100% happy with, but I think in the next 2 weeks or so we'll start getting some momentum in which way the market wants to go, and we will take some fantastic trades going forward. So thank you for listening, and thank you for taking the time to learn about the analysis and the 200-day moving average. I hope it helps with your trading, and have a fantastic week.